Hi guys, Max here, and this is of course your daily market update for yesterday, the 12th of July. And as you can see, we had another rout in the equity markets with most stocks falling on the whole. Tech didn't perform too brilliantly, but it wasn't quite as bad the day before. Some other industries and sectors like energy, for instance, actually did really quite poorly, as did healthcare. And there's a lot of fear in the markets right now because we have quite a rampant week when it comes to new pieces of news that are really going to shake the markets. The big thing for today is the US CPI data that will be coming out, and depending on whether it's good or bad, we could see a massive swing to either side in equities today. As for yesterday then, the S&P 500 fell by 0.9%, the Nasdaq fell by 1%, and the Dow Jones fell by 0.6%, with the Russell 2000 only falling by 0.2%. So a decline for the day, but really in the grand scheme of things, in comparison to what we've seen over recent months where we've had 4% negative days, really nothing too major. Across the rest of the world, it was a similar sort of situation, although slightly better in some limited markets. In the UK, for instance, the FTSE 100 actually rose by 0.2%, and across the rest of continental Europe, the Stoxx 600 rose by 0.4%. Asia and the rest of the Americas, though, weren't particularly strong at all, so the MSCI World Index fell by another 0.8%. Now, as for currencies, the dollar actually didn't strengthen much, but it didn't weaken either. The euro is still sitting at $1, almost exactly $1. They are now at parity, which has been a long time coming and doesn't have any direct consequences itself, but it is representative of the long-term strengthening of the dollar and weakening of everything else, really. The pound is also pretty weak right now, sitting at $1.19, and the yen is still sitting at 137 yen per dollar, so the same sort of story in the world of foreign exchange. Now, for fixed income assets and the bond markets, again, it's been the same sort of story, though this time with just a small decrease in bond yields. The US 10-year Treasury yield fell by 3 basis points for the day and is now at 2.96%. The German and British 10-year yields, though, fell by a fair bit more. The German was down by 11 basis points and the British down by 10, so some volatility in the bond markets as people route out of risk-on equity markets and into safe haven assets like bonds. One thing that we did see actually is another yield curve inversion for the US 10-year versus the 2-year Treasury yield. Right now, it's inverted by about 12 basis points, which is quite a large amount. And in short, this basically means that investors are pricing in rate hikes for the short-term future, but rate cuts for the long-term future. And why does the Federal Reserve reduce interest rates when they do that? Well, they do it to stimulate a struggling economy. So essentially, the bond market is right now predicting a recession in the United States. Now, we did actually have some major volatility in the oil markets once more. It's been a very crazy couple of weeks here. WTI crude oil fell by 8% for the day and is now down to $96 a barrel, with Brent crude sitting at around about $100. This is really nice to see. Cheaper oil is good for pretty much everyone at this point. And the reason for this move isn't going to surprise you at all. It's the exact same reason for the move down from $120 a barrel to $100 in the first place. It's the idea that a global recession is going to dampen demand for oil, and so investors and speculators are pricing this in advance. Finally then, what's happening with gold? Well, prices are a little bit depressed even further. They fell by about 0.5% yesterday, and right now gold is looking quite cheap at $1,724 an ounce. Now over to the crypto market, and it really wasn't that special a day. We didn't see much movement in the markets at all. We left off yesterday with Bitcoin sitting just below $20,000, and it's still at that mark. We also saw Ethereum just above $1,000, and again, it's still round about that mark. Most altcoins were moving by 1 or 2% either direction, but there was no concerted move for the entire market in one direction. Probably because there wasn't any major new news stories breaking and changing investors' minds. Now, we did actually get some news out of the crypto market, and as is so often the case these days, it wasn't good news for the crypto market, and it's surrounding the Grayscale Bitcoin Trust, which is basically just a fund that buys Bitcoin and then allows you to invest in the fund. So it's a roundabout way of investing into Bitcoin, and it's been relatively popular over recent years, getting really quite big. However, more recently, it's been trading at a hefty discount. Now, what I mean by that is if they have one Bitcoin on their balance sheet and Bitcoin is worth $30,000, then GBTC or Grayscale Bitcoin would be worth something like $25,000. So there's been this idea that there's a strong arbitrage opportunity to buy Grayscale Bitcoin. The problem with this is that actually Grayscale was hit relatively hard by the Three Arrows Capital collapse. Reportedly, they had lent them money, as had almost every crypto lending firm or any firm in the crypto space at all. And there are some fears about the ability of Grayscale to stay in business into the future. BlockFi, for instance, another crypto exchange and crypto lending platform that has struggled because it basically irresponsibly gambled people's money. Well, they've announced that they are no longer going to be accepting any kind of Grayscale Bitcoin deposits as collateral because of the risk concerns that they have for that asset as well. Now, this isn't awful for the crypto market, but it isn't good either, and it is just representative of this long-term crypto winter and downturn in this market. Now, of course, as I mentioned earlier, the really big piece of news for today is going to be the CPI data that's coming out of the US later today. It should come out just a few hours after this video goes live. Now, economists are expecting a brand new 41-year high of around about 8.8% for inflation for year-over-year figures. Now, there has also been a potentially and a probably fake leak of the inflation data. It's this document here. I'm not going to go through it all because there's a decent chance that it isn't real, but it is saying that there's going to be a 10.2% year-over-year figure. The Fed has come out and said that, though, no, this is fake, but it's still worrying some investors anyway. If the data comes out in a few hours and it is 10.2%, then, well, we know that this is a reliable source into the future. But right now, most investors seem to be thinking that it isn't really worth betting on this being real at this point. What is real, though, is the fact that at the moment, every fear in an investor's mind is based around this CPI data release. Every investor all over the world, not even just the US, is watching this come out. If it is another brand new 41 or 42-year high, as is predicted, the Fed will continue to hike interest rates, probably by 75 basis points for this month, which is going to be a major hit to the debt markets once again. And so we can expect equity markets to continue to decline. Of course, the narrative that the mainstream media has been pushing recently has been that inflation has peaked and it's on the way back down and it's time to stop worrying. And so it's time for the Fed to ease off the gas pedal. But in my opinion, it is sort of starting to look like this whole inflation is transitory nonsense all over again. The same sort of people saying the same sort of thing, just rewording it so that they aren't disgracing themselves by mentioning the word transitory. Now, we have some corporate news to talk about, starting off with Klarna, which has basically seen its private valuation drop by 85%. Now, Klarna was sort of Europe's darling child tech company. It's probably the biggest and most popular tech company to come out of Europe in recent years, or at least over the last bull run. And it's basically a buy now, pay later system. This is a huge industry and it's very, very controversial because it causes a lot of people to find themselves in debt, buying things that they can't afford and spreading the payments out over multiple months so that they feel like it's less. Now, personally, I'm really not too sure why it's such a controversial principle because it's practically identical to the idea of a credit card, and pretty much no one thinks that credit cards are immoral, but buy now, pay later has a massive amount of criticism and people saying that it should be illegal. For Klarna in particular, though, that isn't the main concern right now. The main concern is that actually the monetary environment has changed and Klarna is no longer the darling child of the European tech scene. The problem for the company is pretty simple. There are loads of different competitors for Klarna, and Klarna doesn't really have a moat. There are literally 100 different buy now, pay later systems, and they're all really easy to integrate onto a website when you're selling your products. And the customer just uses whichever one they have an account with. There really isn't much of a moat for a company like Klarna. Now, as a result of this problem and the fact that financing and debt's getting more expensive as interest rates are being hiked, well, Klarna has seen its valuation drop from $45 billion for this company a year ago to $7 billion just now, which is an absolutely massive hit. This is absolutely a wake-up call, not only to the people who thought that the 2021 market conditions would last forever and that they would never again see a down market in tech companies or anything like that, but also to those people who thought that private markets were different and that as long as a company doesn't go public, it will keep being able to raise money at successively higher levels. Both of those ideas were obviously very naive. They were based on this whole "this time it's different" principle, and of course it never is different. Now we have a little bit more news coming out of Peloton, another tech company that is really easy to laugh at because it's such a massive failure recently. Now, the company has been absolutely hammered. It was, of course, billed as a tech company, despite the fact it never really was. Its share price is down by 94%. That is a ridiculous number. This company was very popular with a bunch of hype YouTubers who bought into loads of other companies which were overvalued in simple terms. Meet Kevin, for instance, bought $1 million worth of Peloton stock back in 2021 when it was near its peak. Now, the whole investing thesis of this sort of company was the idea that it will make its own stuff, it will innovate, it will be the growing company, the smart one that invests into its future. And it will basically come out to dominate the gym equipment world and will become the only company that supplies gyms with any kind of equipment like treadmills and bikes into the future. Now, this was incredibly naive to think, and the evidence of that is the fact that Peloton have just come out and said that they won't even be making their own bikes anymore. They built a $400 million factory, which is about half of the entire cash on hand that the company has at this point. And this factory's only purpose was to build the bikes and the treadmills that this company sells. However, they found out that they can't do it cheaper than the place that they used to get it built in Taiwan, because innovating isn't as simple as just wanting it more than other companies. Every company out there has the same mandate to maximize profit, and they're all trying to make the same innovations that you are. They've all done the same calculations, and when you come to a different conclusion, either you're wildly right and you're going to create a $1 trillion company, or more likely, you're going to be wrong in the end. And that's what we've just seen happen with Peloton here. Finally then, for the day, we're just going to finish up with just a little bit about the United Kingdom and our Conservative Party leadership election, because it is going to impact markets depending on who is elected and who becomes the next Prime Minister. Now, the first thing to mention is that it seems every single candidate wants to change the Northern Ireland Protocol, which is going to cause a conflict with the EU, not a physical armed one, but a lot of, political posturing and some angry politicians who maybe put into place laws which are detrimental to trade between the United Kingdom and the rest of Europe. Trade disputes are going to be very likely going into this, and so this sort of needs to be accounted for if you're invested in either British or European companies. Another thing worth mentioning is that actually all of these leadership candidates are also following the same sort of stance that Boris Johnson had on Ukraine. They are very pro-Ukraine and they want to continue to assist Ukraine, hoping to help it defeat Russia in this war, which means that actually it's likely that this war is going to continue into the future. And then finally, these candidates all seem to be focusing on low tax and low spending, bringing the size of the government down, but also somehow getting the economy going. And here's the big problem with what all of these candidates are talking about, and something that most people and normal people really aren't even thinking about, and it's of course inflation once again. Now, I've pulled up this tweet here from a guy called Thomas Skinner. Now, if you're not British, you probably don't know who he is, and even if you are, you might not, but he was on The Apprentice. He was quite a funny guy, and he's gone on to start a mattress bed company that seems to be doing well by all accounts. And I don't mean to pick on him here in particular, but what he said here really encapsulates the problem with the average person and how little they understand about inflation. So what he said is, this country is on its knees. We need to be run by proper people who know how to look after the public, hard-working grafters who understand how to resolve our problems. Now, here's the really important bit. We can get out this recession by helping out the public financially and get people spending again. Now, Thomas Skinner is by all means a good businessman. He's running a successful business, but he clearly doesn't understand that the reason we have such high inflation is because people have been spending too much money, because we have too much demand from gross monetary and fiscal policy run by an irresponsible government who refuse to turn the money printer off. If we want to get inflation down, we have to do the opposite. We can't stimulate inflation yet. We need to let the economy reset. We need to let people's incomes and asset prices in particular go back to their natural levels when they aren't being inflated by quantitative easing. The sad thing here is that actually this guy just doesn't understand that the thing that he thinks is a solution would just make this problem worse in the long run. It would just cause inflation to continue to spiral out of control, and it wouldn't solve any problem. And so many people agree with them because they don't understand what inflation really is either, and they don't understand why it's here. Now, this problem of not understanding inflation is obviously not exclusive to the British public. It's present in every country in the world. No one really understands it unless you're interested in finance and investing. It's the exact same thing over in the US, which is why certain places like California are talking about stimulus bills to help lessen the effect of inflation, when stimulus checks are one of the main reasons for inflation. As we enter into certain elections in the US, as we get further on into 2023 and we start looking at the US presidential election, if inflation is still really high, there's going to be a massive problem, because it will be popular to say that the Americans should spend their way out of a recession, as is a typical method. And most politicians will probably just ignore the fact that inflation is high and hope that no one really realizes the problem there. And that's the thing, most people won't. And so there is the potential that our governments find themselves pandering to their voters too much, unwilling to tell them that they're wrong, and making the situation worse as a result. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to iTrust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join iTrust Capital. Thank you all for watching. Stay stoic. Until next time.